There is a sound you hear on Wall Street. It's not the opening bell or the roar of the trading floor. It's a whisper, a quiet, frantic, rhythmic whisper that happens 4 times a year. It's the sound of millions of investors, analysts, and executives holding their breath, waiting for a single number. Earnings per share. Did they beat the estimate? Did they miss? By a penny? By 2 cents? And in that moment, in the collective exhalation of relief or gasp of horror, fortunes are made and lost. Trillions of dollars of market value are rearranged based on a 3-month accounting summary. A great American company, a titan of industry with a 100-year history, can lose 10, 15, 20% of its value in minutes because it sold a few less widgets than a 28-year-old analyst in a cubicle predicted it would. This is the game, and for 99% of investors, it is the only game they know. They are slaves to this quarterly rhythm, their emotions and their portfolios tethered to a metronome of manufactured hope and panic. But there is another way. There is a man in Omaha, Nebraska, who has built one of the greatest fortunes in human history by completely, utterly, and ruthlessly ignoring this game. Warren Buffett doesn't just disregard quarterly earnings. He actively profits from the chaos they create. He understands a fundamental truth that escapes almost everyone else. The market's obsession with the short term, its addiction to the quarterly report card, is not a feature of intelligent investing. It is a mass psychological defect. And like any defect, it can be exploited. It creates breathtaking opportunities for the patient, rational investor to buy wonderful businesses from panicked sellers at deeply discounted prices. This is the final promise of value investing. It is the transformation from being a pawn in Wall Street's game to becoming the house. Today, you are going to learn how to unplug from the noise. You will learn to see a 20% price drop not as a catastrophe, but as a potential sale tag on a world-class asset. You will learn to turn the market's greatest weakness, its myopia, into your greatest strength. This isn't about a hot stock tip or a complex trading algorithm. This is about rewiring your brain. It's about installing a new operating system for financial decision-making, an OS built on logic, patience, and the profound understanding that you are not buying a stock, you are buying a business. And great businesses are not built in 90-day increments. They are built over decades. Let us begin by traveling back in time, to a place where this entire philosophy was born, not on a chaotic trading floor, but in the quiet, wood-paneled lecture halls of post-war America. It was here that a young Warren Buffett first encountered the single most powerful metaphor in the history of finance, an allegorical character who would become his lifelong business partner and his greatest source of profit, the manic-depressive Mr. Market. To truly understand how to profit from Wall Street's panic, you must first be formally introduced to the man who causes it. His name is Mr. Market, and he was introduced to the world by a brilliant professor at Columbia Business School named Benjamin Graham. Imagine, for a moment, that you own a piece of a private business. You paid a fair price for it, you understand its operations, and you're confident in its long-term prospects. Now, imagine you have a business partner. This partner, Mr. Market, is a peculiar fellow. He is incredibly accommodating, but he suffers from incurable emotional problems. Every single day, without fail, he shows up at your door and offers you a price. He tells you what he thinks your share of the business is worth, and he offers to either buy you out or sell you his share at that exact price. The strange thing about Mr. Market is that his mood swings are epic. On some days, he arrives euphoric, seeing nothing but a glorious, profitable future for your business. On these days, he quotes a ridiculously high price. He is desperate to buy your stake, convinced that the value can only go up. On other days, he appears in a state of deep depression. He is terrified, seeing nothing but trouble ahead for your industry and the world. On these days, he quotes a miserably low price, practically begging you to take his shares off his hands at a fraction of their real worth. This was the parable that Benjamin Graham taught his students, a young Warren Buffett among them in the early 1950s. It wasn't just a clever story, it was a revolutionary mental model for interacting with the stock market. At the time, the market was seen by many as a source of wisdom, a discounting mechanism that rationally priced assets based on all available information. Graham's story turned that idea on its head. He depicted the market not as a wise sage, but as an emotionally unstable business partner. The implications were profound. If Mr. Market is a manic depressive, then his daily price quotes are not a reflection of true value. They are a reflection of his emotional state. His euphoria doesn't mean your business is suddenly worth more, and his despair doesn't mean it's worth less. The business itself, its factories, its brand, its earning power, hasn't changed. Only his perception has. The choice, Graham taught, is yours. You are free to ignore him completely. You can go about your day, confident in your own assessment of the business's value. But on those rare occasions when his panic and despair lead him to offer you a truly foolish price, a price far below what you know the business is worth, you have the opportunity to take advantage of his weakness and buy his shares cheap. Conversely, when his wild optimism leads him to offer you a sky-high price, you have the option to sell your own shares to him. For the young Buffett, this was an epiphany. It framed the entire endeavor of investing not as forecasting the market's movements, but as responding rationally to its irrationality. The quarterly earnings game is the modern high-speed incarnation of Mr. Market's mania. The instant an earnings report is released, Mr. Market has a violent mood swing. If the company reports earnings of $1.01 per share when analysts expected $1, he becomes wildly euphoric. The price soars. He sees a future of limitless growth. If the company reports 99 cents, he plunges into a deep, dark depression. He is convinced the business is failing, that management has lost its way, that competition is overwhelming them. He offers to sell you his shares at a 15% discount from what he was offering them for just moments before. The underlying business is functionally identical in both scenarios. A single penny difference in a 3-month accounting period has no material impact on the company's long-term competitive position or its decade-long earning power. But to Mr. Market, it's the only thing that matters. This is the opportunity. The intelligent investor, the student of Graham and Buffett, understands that this quarterly panic is just their old business partner, Mr. Market, having one of his fits. And it is during these fits that great companies go on sale. The reason this simple parable of Mr. Market holds such immense power is because it directly confronts several deep-seated psychological biases that lead the average investor to financial ruin. The human brain is a marvel of evolution, but it was not designed to navigate the abstract, emotionally charged environment of the financial markets. Mr. Market's daily offers exploit these design flaws with ruthless efficiency. The first and most powerful principle at play is the raw, visceral power of asterisk loss aversion, THURAS. Pioneering work by psychologists Daniel Kahneman and Amos Tversky demonstrated that for the human mind, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. A 10% drop in your portfolio feels twice as bad as a 10% gain feels good. When a company misses its quarterly earnings and the stock plummets 15% in a day, Mr. Market isn't just offering you a lower price. He is injecting a potent dose of financial pain directly into your psyche. The impulse to sell, to make the pain stop, is overwhelming. You see the red on the screen, and your amygdala, the primitive part of your brain responsible for the fight-or-flight response, takes over. It screams, "Danger! Get out now before it goes to zero!" It doesn't care about the company's price-to-earnings ratio or its return on equity. It just wants the perceived threat to disappear. Buffett's personification of the market as an emotional wreck is a brilliant cognitive trick. It reframes the situation. Instead of seeing a dangerous threat, you see a pathetic, panicked partner. It shifts the emotional response from fear to pity, or even better, to predatory opportunism. You are no longer the victim of the price drop. You are the calm, rational observer of someone else's irrationality. This mental shift is the first step toward achieving the financial freedom that comes from contrarian investing. The second bias at work is the asterisk availability heuristic. This is our tendency to overestimate the importance of information that is easily available to us. The quarterly earnings report, the subsequent stock price plunge, the screaming headlines on financial news networks. This information is immediate, vivid, and emotionally charged. It fills our entire field of vision. The company's 10-year history of consistent growth, its durable brand name, its rock-solid balance sheet. This information is abstract, less immediate, and requires effort to recall from an annual report. The availability heuristic tricks our brain into believing that the most recent, most dramatic information is the most important. Mr. Market is the master of this heuristic. He shoves the quarterly miss in your face and screams that it is the only thing that matters. The intelligent investor builds a system to counteract this. They deliberately focus on the less available but more important long-term data. They force themselves to read the 10K annual report before ever looking at the 10Q quarterly report. They prioritize the decade over the day. By understanding that your brain is hardwired to overreact to the latest news, you can take conscious steps to dampen that reaction and focus on the signals that truly matter for long-term portfolio growth. So how do you translate this psychological understanding into a practical, repeatable process? The mental model is simple in concept, but requires immense discipline and practice. Treat the market as a servant, not a master. This is the blueprint for building a fortress of rationality around your capital. Here is the step-by-step process to implement it in your own wealth management strategy. Step 1 is to externalize and personify. Do not think of the market as an amorphous, all-knowing entity. Give it a name and a personality, just as Graham did. Call him Manny the Manic or Jittery Jim. This act of personification is not trivial. It is a powerful psychological tool. It creates a mental distance between you and the market's price fluctuations. When your favorite stock drops 10%, you are not losing money. Instead, Manny is having another one of his panic attacks. This reframing drains the emotional charge from the event and allows for a more logical response. Step 2 is the cornerstone of all value investing. You must calculate a company's intrinsic value before you look at its stock price. You must do your homework first. Analyze the business, its financials, its competitive position, and come up with a range of what you, as a prudent business person, would be willing to pay for the entire company. This is your number, your anchor of rationality. Without it, you are adrift in a sea of other people's opinions. The stock price is Mr. Market's opinion, not a definitive statement of value. Your intrinsic value estimate is your defense against his emotional manipulation. Step 3 is to reframe your daily interaction with the market. Do not ask, "What is the market doing today?" Instead, ask, "What is Manny offering me today?" This subtle shift in language transforms you from a passive price taker into an active opportunist. You are no longer at the mercy of the market's whims. You are now a discerning buyer, waiting patiently for your partner to make a foolish offer. You check the prices not for validation or guidance, but for bargains. Most days, the answer to "What is Manny offering?" will be nothing interesting. His prices will be at or above your calculated intrinsic value. On these days, your correct course of action is to do nothing. This is perhaps the hardest part of the process for most people. Step 4 is to cultivate the extraordinary discipline of inaction. Your default setting must be no. 99% of the time, the correct decision is to ignore Mr. Market's offers, whether they are hysterically high or pitifully low, but not yet in bargain territory. True long-term investing is not about constant activity. It's about occasional, decisive action when the odds are overwhelmingly in your favor. It's the financial equivalent of a lion hunting. Long periods of patient waiting, followed by a short burst of decisive action when a high-probability opportunity presents itself. This process inverts the relationship most people have with the market, setting you up for a lifetime of beating the market not by outsmarting it, but by patiently taking advantage of its predictable foolishness. To fully appreciate the power of this mental model, we must examine the opposite approach, the path walked by 99% of market participants. This is the path of the reactive investor, the individual who sees Mr. Market not as a servant, but as a guru. Their financial life is a stressful, chaotic, and ultimately unprofitable dance of reactions. The day for this investor begins not with a cup of coffee and a review of their business holdings, but with a jolt of anxiety. They grab their phone, their heart pounding, to check the pre-market futures. What is the mood of the great guru today? Is he pleased? Is he angry? Their entire emotional state for the day is set by this digital oracle. They turn on financial television not for information, but for interpretation. They listen to commentators explain why the market is up or down, internalizing these just-so stories as profound truths. When a company they own is about to report earnings, they don't review their own intrinsic value calculation. Instead, they search frantically for the whisper number, the unofficial estimate that real traders are supposedly using. Their focus is entirely external. They have outsourced their financial thinking to the crowd. When the earnings number hits, their reaction is Pavlovian. If the company beats the estimate and the stock soars, they are filled with a sense of genius. They might even buy more, chasing the momentum, convinced the stock can only go up. They are buying into Mr. Market's euphoria. If the company misses the estimate and the stock craters, a cold panic sets in. The guru is displeased. The commentators speak in grave tones of headwinds and execution issues. The investor's first thought is not, is the long-term story of the business still intact? It is, how can I get out before this goes lower? They sell, crystallizing a temporary paper loss into a permanent one, just to appease the angry god of the market. Their portfolio is not a curated collection of fine businesses. It is a chaotic jumble of recent reactions. It is a fossil record of past hopes and fears. They own stocks that are hot, which they bought at euphoric peaks, and they have sold stocks that were broken, often at the point of maximum pessimism. They mistake all this activity, the buying, the selling, the constant monitoring, for productive work. In reality, it is value destructive. They are playing Mr. Market's game by his rules, and it is a game rigged for him to win. They are perpetually buying high in excitement and selling low in fear, the exact inverse of the formula for building long-term wealth. This path is not just financially ruinous, it's emotionally exhausting. It turns the process of investing, which should be a calm and empowering part of securing one's financial freedom, into a constant source of stress and regret. How does this philosophical difference, viewing the market as a servant versus a master, translate into cold, hard cash on a balance sheet? The financial connection is direct, powerful, and it manifests in two crucial ways: the creation of a margin of safety and the dramatic reduction of wealth-destroying costs. Firstly, by only buying when Mr. Market is in a state of panic and offering you a significant discount to your calculated intrinsic value, you are systematically building a margin of safety into every investment you make. This concept, also from Benjamin Graham, is the bedrock of risk management in value investing. If you calculate a business is worth $100 per share and you buy it for $60 during an earnings-induced panic, you have a $40 buffer. This buffer protects you from a multitude of sins. It protects you if your initial valuation was slightly too optimistic. It protects you if the business encounters unforeseen problems. It gives you staying power. The financial statement impact is a drastically lowered cost basis on your assets. A lower cost basis means your eventual capital gains will be magnified when the price inevitably reverts to its true value. Investors who buy into euphoria at $120 have no such buffer. Any minor setback puts them underwater and triggers their loss aversion, leading to panic selling. Your margin of safety is their moment of terror. Secondly, this approach fundamentally alters the cost structure of your investment operations. The reactive investor, the one who follows Mr. Market's every whim, is in a state of constant portfolio churn. They are always buying and selling, and every single transaction incurs costs. There are explicit costs, like commissions and fees. But far more damaging are the implicit costs. Every time they sell a winning stock to lock in profits, they trigger a capital gains tax event. This is a catastrophic unforced error. They are voluntarily sending a percentage of their principal to the government, money that could have been left to compound for decades. An investor who buys a great business at a fair price and holds it for 20 years pays zero capital gains tax for 20 years. The entire sum is free to work its magic of compounding. The reactive investor who trades in and out of the same stock multiple times over that period is constantly bleeding capital to taxes and fees. The financial connection is this: treating the market as a servant leads to a portfolio characterized by low turnover, high conviction, tax efficiency, and a built-in margin of safety. Treating it as a master leads to a portfolio characterized by high turnover, low conviction, tax inefficiency, and a constant state of vulnerability. Over an investing lifetime, the difference in these two approaches is not a matter of a few percentage points. It's the difference between modest portfolio growth and the kind of generational wealth that grants true financial freedom. Wall Street's obsession with quarterly earnings is a spectacle of false precision. It's an entire industry built on the absurd premise that the long-term value of a complex global enterprise can be accurately forecasted and judged within a 90-day window. This creates a powerful illusion of control and knowledge, but it is a fallacy. To illustrate how Buffett pierces this illusion, we must look at one of his most iconic investments, the Washington Post Company. In 1973, the stock market was in a brutal bear market, and newspaper stocks were particularly despised. The consensus view was that they were an outdated business, soon to be crushed by the rise of television. On top of this industry-wide pessimism, the Washington Post was facing its own set of problems. It had just gone through a costly strike, and its earnings were unimpressive. Wall Street, with its laser focus on the next quarter's results, saw a declining company in a dying industry. Mr. Market was in a deep depression. The entire company, which owned not just the flagship newspaper but also Newsweek magazine and several valuable television stations, had a market capitalization of around $80 million. Warren Buffett, however, was not looking at the latest quarterly report. He was reading the company's past annual reports and thinking about its future. He saw something that the market, in its myopic focus on the present, was completely missing: a formidable and enduring competitive advantage, what he would later call a moat. The Washington Post was the dominant newspaper in a powerful city. It had what economists call a franchise. It had pricing power with advertisers and a loyal readership. Furthermore, he saw that the television stations it owned were essentially licensed monopolies, gushing cash with very little capital required. He did a simple calculation. He added up the value of the television stations alone and realized they were worth more than the entire company's market price. In essence, if you bought the stock at the prevailing price, you were getting the world-famous Washington Post newspaper and Newsweek magazine for free, and then some. The market, obsessed with the recent strike and the quarterly earnings dip, was pricing the company for disaster. Buffett, looking at the durable assets and the long-term earning power, saw one of the greatest bargains of his life. He began buying shares aggressively. Between 1973 and 1974, Berkshire Hathaway invested $10.6 million to acquire a substantial stake in the company. He wasn't betting on the next quarter's advertising revenue. He was betting that over the next 10 years, the powerful franchise of the Washington Post would reassert itself. He was betting on the brilliant and courageous leadership of its CEO, Katharine Graham. The market was playing checkers, looking one move ahead. Buffett was playing chess, looking a decade ahead. And the result? Over the next 30 years, that $10.6 million investment grew to be worth over $1.2 billion, a return of more than 100-fold. This is the power of ignoring the fallacy of precision. While Wall Street was debating whether earnings would miss by a penny or two, Buffett was buying a world-class collection of media assets for less than the price of one of its divisions. He exploited the market's short-term focus to achieve a level of portfolio growth that seems almost impossible, all by focusing on the business, not the noise. The quarterly earnings game is built on a powerful cognitive bias known as asterisk, anchoring, and adjustment, The process starts when a group of financial analysts publish their earnings per share, or EPS, estimates for a company. This number, whether it's $1.25 or 83 cents, becomes a powerful psychological anchor. From that point on, all subsequent discussion and evaluation is tethered to this arbitrary number. The company's actual reported earnings are then judged not on their own merits, not on whether the business generated strong cash flow or gained market share, but solely in relation to that anchor. Did it beat or miss? The entire narrative is framed by this initial, often flawed estimate. The market then makes small adjustments from this anchor. A beat means the company is doing great, and the price is adjusted upward. A miss means it is failing, and the price is adjusted downward. The problem is that the initial anchor itself is often meaningless. It's a guess, an estimate about a future that is inherently unpredictable. A massive, multi-billion-dollar business is a complex ecosystem, not a Swiss watch. A shipment delayed by a storm, a customer paying an invoice a week late, a slight change in currency exchange rates. Any number of trivial, non-fundamental factors can cause a company to miss its earnings estimate by a penny. This doesn't mean the business is 15% less valuable than it was yesterday. It just means the inherent randomness of the world didn't perfectly align with an analyst's spreadsheet. This leads to another critical bias, the asterisk narrative fallacy asterisk, a term coined by Nassim Nicholas Taleb. Our brains crave simple stories to make sense of a complex world. The beat, or miss, provides the seed for a simple story. A company beats earnings? The story is, the CEO is a genius, their new product is a hit, the future is bright. A company misses earnings? The story is, management is incompetent, their strategy is failing, competition is eating their lunch. These stories are simple, emotionally satisfying, and almost always wrong. They are a dramatic oversimplification of reality. The investor who falls for the narrative fallacy stops thinking critically. They accept the story presented by the market and financial media. The intelligent investor, the contrarian investor, resists this. They understand that a single data point, like a quarterly earnings number, is not a story. It is noise. The real story of the business is written in decades of annual reports, in the analysis of its competitive advantages, and in the quality of its management. By recognizing that the entire earnings game is a psychological trap built on a false anchor and simplistic narratives, you can liberate yourself from its influence. You can stop reacting to the stories and start reading the facts, giving you a massive edge over the 99% of investors who are hopelessly caught in the narrative web. This is a crucial skill for anyone serious about stock picking and long-term wealth management. To break free from the quarterly hypnosis, you need a new mental model. You need a different set of questions to ask. Instead of "what will earnings be this quarter?" you need a framework that forces a long-term perspective. Let's call this model the 5-year test. It's a simple blueprint you must run through. Before you allow yourself to even look at a quarterly earnings report or the market's reaction to it. It acts as an inoculation against short-term thinking. Here are the questions you must answer, preferably in writing, to force clarity of thought. Question 1. In 5 years, is it highly probable that this company will be earning significantly more money than it is today? This question immediately shifts your focus from the next 90 days to the next 825 days. It forces you to think about the company's growth trajectory, its addressable market, and its fundamental ability to increase its earning power over a meaningful period. A single bad quarter becomes almost irrelevant in this context. Question 2. In 5 years, will this company's competitive advantage, its moat, be wider and deeper than it is today? Think about the source of its strength. Is it a brand? A network effect? A low-cost production process? Your task is to determine if the company's actions today are strengthening or weakening that moat for the long haul. A company might miss quarterly earnings because it's investing heavily in research and development, which strengthens its moat. The short-term focused market will punish it for this, while the long-term investor will see it as a positive sign. Question 3. Is the management team making decisions that will benefit the company over the next 5 years, or are they managing to please Wall Street for the next 3 months? Listen to their conference calls. Read their shareholder letters. Are they talking about long-term strategic initiatives, or are they making excuses for tiny quarterly fluctuations? A management team that sacrifices long-term value for a short-term earnings beat is a massive red flag. This is a critical distinction for entrepreneurs and investors alike. Question 4. What are the major unstoppable secular trends that will act as tailwinds for this business over the next 5 years? Is it the shift to cloud computing? The aging of the population? The rise of e-commerce? A great business often has a powerful external trend at its back. A bad quarter doesn't stop a tidal wave. By focusing on these powerful, slow-moving trends, you can learn to ignore the temporary choppy waves of quarterly results. Only after you have thoughtfully answered these 4 questions are you permitted to look at the quarterly report. By then, your mindset will have fundamentally shifted. You will see the report not as a final grade, but as a single data point on a long journey. You'll be able to place it in its proper context, analyzing it for clues about the long-term trajectory rather than reacting to the headline EPS number. This is how you move from being a speculator on quarterly noise to being a long-term owner of a business. This is the essence of professional asset allocation. The path of the 99% is paved with quarterly earnings reports. The person on this path is not an investor, they are an earnings season gambler. Their entire strategy revolves around predicting and reacting to these 4 frenetic periods each year. Their research process is a shallow hunt for clues about the upcoming report. They subscribe to services that track channel checks and supply chain rumors. They scrutinize analyst reports not for business insights but for upgrades and downgrades, which are almost entirely driven by short-term earnings expectations. Their calendar is marked with report dates, and the days leading up to them are filled with anxiety and speculation. They might even dabble in options, making highly leveraged bets on which way the stock will move after the announcement. This isn't investing, it's a trip to the casino. When the earnings release crosses the wire, the gambler's brain is flooded with adrenaline, their finger hovers over the buy or sell button. If the company beats the estimate and the stock begins to soar in after-hours trading, they feel a rush of validation. They might chase the stock higher, desperate not to miss out on the rally. They are buying on pure emotion, with no thought to valuation or the underlying fundamentals of the business. If the company misses the estimate and the stock begins to tank, they are seized by a frantic panic. Their carefully constructed hopes are shattered. They don't pause to read the report or listen to the conference call to understand the reasons for the miss. Their only thought is to sell, to cut their losses before the damage gets worse. They sell directly into the maw of peak pessimism, often liquidating their position at the very bottom. The great irony is that the earnings season gambler believes they are sophisticated. They use the jargon of Wall Street, talking about guidance and organic growth. They believe their constant activity and monitoring of the news makes them an informed market participant. In reality, they are the fish at the poker table. They are providing the liquidity and the profits for the patient, long-term investors who are sitting on the other side of their emotional trades. This path is a surefire way to experience the worst of what the market has to offer: maximum stress, maximum costs, and minimum returns. It is a constant cycle of hope and despair, driven by a set of numbers that, for a true business owner, are little more than a footnote in a much longer and more important story. The financial consequence of abandoning the quarterly earnings game in favor of the 5-year test is a fundamental restructuring of your entire portfolio and its return potential. It directly impacts your ability to achieve significant capital gains and build lasting wealth. When you focus on the long-term earning power of a business, you naturally gravitate towards a different type of company. You start to ignore the volatile, high-flying story stocks with no profits and instead focus on durable, cash-generative businesses with wide moats. Your portfolio's composition shifts from speculative to resilient. This directly improves your chances of beating the market over the long run. Studies have consistently shown that the vast majority of the market's long-term returns come from a surprisingly small number of super-compounder stocks. These are the companies that deliver phenomenal returns over decades. By constantly churning your portfolio based on quarterly earnings, you almost guarantee that you will never hold one of these long-term winners. You'll sell a future Amazon because of one disappointing quarter for shipping costs. You'll dump a future Apple because iPhone sales were slightly below estimates for a 90-day period. The 5-year test is designed to help you identify and, more importantly, hold on to these generational companies through their inevitable periods of short-term difficulty. Furthermore, this long-term approach has a massive impact on your tax bill, which is one of the biggest yet most overlooked drags on portfolio growth. Let's imagine two investors. Investor A, the earnings gambler, achieves a 12% return in a year on a stock and sells it, paying a 20% short-term capital gains tax. Their real return is only 9.6%. Investor B, the long-term owner, also sees their stock appreciate by 12%. They do nothing. Their entire 12% remains invested, compounding for the next year. Over 30 years, Investor B's portfolio, thanks to the uninterrupted power of tax-deferred compounding, will be vastly larger than Investor A's, even if their gross annual returns were identical. The financial connection is undeniable. Ignoring quarterly noise and focusing on the long-term business allows you to identify and hold supercompounders, minimize wealth-destroying taxes and transaction costs, and let the magic of compounding work for you uninterrupted. It changes the mathematical equation of your financial future, transforming it from a frantic struggle for small gains into a calm, systematic process of wealth accumulation. This is the foundation upon which true financial freedom is built. There is a moment in every market cycle when fear turns to blind panic. It's when a piece of bad news, specific to a single company, metastasizes into an existential crisis. The narrative shifts from, "they're having a tough quarter," to, "they might not survive." The sellers come out in droves, and the stock price doesn't just drift lower, it collapses. For the 99%, this is a signal to run for the hills. For the true value investor, this is the dinner bell. It is the moment when a great business can be unfairly punished for a temporary stumble, creating the investment opportunity of a lifetime. The textbook example of this principle, the foundational story every serious investor must know, is the saga of the Great Salad Oil Scandal of 1963 and how it made Warren Buffett a fortune. The protagonist was American Express, a blue-chip company known for its travelers, checks and credit cards, a symbol of financial integrity. Their seemingly boring but profitable warehousing division had a major client, the Allied Crude Vegetable Oil Company. Allied borrowed huge sums of money from banks, with the loans secured by their inventory of salad oil, which was stored in American Express's tanks. The problem was, the salad oil didn't exist. Allied's president had filled the tanks mostly with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied defaulted, leaving the banks holding worthless collateral. Wall Street panicked. The banks sued American Express, claiming they were liable for the fraudulent warehouse receipts. The market's reaction was swift and brutal. The narrative became, American Express is on the hook for massive, potentially company-ending liabilities. The stock, which had been trading around $60 a share, plunged to $35. Mr. Market was not just depressed, he was suicidal. He believed American Express, the bastion of trust, was facing bankruptcy. Warren Buffett, then a young, relatively unknown partnership manager, saw the panic and became intensely interested. But he didn't look at the stock chart or listen to the Wall Street rumors. He did something radically simple. He went out and investigated the actual business. He went to restaurants and travel agencies. He talked to merchants. He asked them a simple question: are you still accepting American Express cards and travelers' checks? The answer was a resounding yes. He observed customers, who were completely unaware of the warehousing scandal, continuing to use their Amex products with total confidence. He realized something profound. The scandal, while serious for the warehousing division, had not damaged the company's real asset, its crown jewel, the powerful brand and the trust it commanded in the minds of consumers and merchants. The moat was perfectly intact. The market was confusing a problem in a small, non-core part of the business, with a fatal blow to the entire enterprise. Convinced that the market's punishment was wildly disproportionate to the actual crime, Buffett acted decisively. He invested $13 million, nearly 40% of his partnership's entire capital, into American Express stock. It was a massive, concentrated bet. His partners were nervous. Wall Street thought he was insane. But within a few years, the company settled the lawsuits for a manageable sum, the scandal faded from memory, and the core credit card and traveler's check businesses continued their relentless growth. The stock price soared. Buffett's partnership made a fortune, and the legend of the salad oil scandal became a masterclass in contrarian investing. It teaches us the core lesson. When a great company stumbles, the market often panics and shoots the horse, even if it only has a broken leg that will heal. The job of the intelligent investor is to calmly inspect the horse, determine the true extent of the injury, and if the long-term prognosis is good, buy it from the panicking crowd for pennies on the dollar. This is how you execute the strategy of buying the dip, not recklessly, but with surgical precision. The market's overreaction to the salad oil scandal is a perfect illustration of a powerful and dangerous cognitive bias, catastrophic thinking. When faced with negative and uncertain news, the human brain has a tendency to extrapolate the worst possible case scenario. We don't just see a problem, we see ruin. The traders who dumped American Express stock weren't thinking, this will result in a manageable financial settlement and a temporary dip in earnings. They were thinking, the liabilities are unlimited, they're going bankrupt, this is going to zero. This is a survival mechanism left over from our evolutionary past. When our ancestors heard a rustle in the grass, it was safer to assume it was a lion than to assume it was the wind. The one who assumed it was the wind and was wrong got eaten. The one who assumed it was a lion and was wrong was just a little jumpy. In the modern financial world, this assume the worst instinct is financially lethal. It causes us to sell wonderful assets at the point of maximum fear, locking in permanent losses. Compounding this is *docs confirmation bias *, our tendency to seek out and interpret information that confirms our pre-existing beliefs. Once the catastrophic narrative takes hold, Amex is doomed, investors start looking for evidence to support it. They'll focus on the angriest quotes from the suing banks. They'll find an analyst who predicts bankruptcy. They'll ignore any information that contradicts the doom narrative, like the fact that consumers were still happily using the company's products. They build an echo chamber of fear that reinforces their initial panic. Warren Buffett's genius was to consciously and systematically override these biases. He did not engage in catastrophic thinking. Instead, he engaged in probabilistic thinking. He asked, what is the range of possible outcomes? And what is the probability of each? He knew bankruptcy was a possible outcome, but he assessed its probability as extremely low. He assigned a much higher probability to the outcome where the company settles the lawsuits and its core business continues to thrive. He actively fought confirmation bias by seeking out disconfirming evidence. While Wall Street was talking to lawyers, Buffett was talking to restaurant owners and customers. He was looking for real-world data that would either support or refute the panic narrative. He found overwhelming evidence that the brand was unharmed, a powerful piece of disconfirming evidence that the market was ignoring. Understanding these biases is the key to unlocking the unfair punishment principle. You must recognize that when bad news hits, your brain and the collective brain of the market will instinctively jump to the worst possible conclusion. Your job is to take a deep breath, step back from the emotional vortex, and become a dispassionate investigator of the facts, just like Buffett did in 1963. This is the psychological discipline required for successful stock picking during a market crash. How can you, as an individual investor, systematically determine if a company's stock price collapse is a true buying opportunity or the beginning of a death spiral? You need a practical tool, a mental model that guides your analysis during a crisis. Let's call it the Moat Integrity Checklist. When a company you admire is being unfairly punished, you must run it through this disciplined 4-part checklist before you even consider buying a single share. Step 1. Has the core competitive advantage, the moat, been structurally damaged? A moat is the sustainable advantage that protects a company from competitors, allowing it to earn high returns on capital. It could be a powerful brand like Coca-Cola, a network effect like Facebook, a low-cost process like Geico, or a government patent. The scandal at American Express was a financial and legal problem, but it did not damage their brand moat with consumers. A factory fire at a manufacturing plant is a temporary problem. A revolutionary new technology from a competitor that makes your product obsolete is structural damage. You must be brutally honest in this assessment. Step 2. Is this a one-time survivable event, or is it a symptom of a deeper systemic rot? The salad oil scandal was a one-time fraud perpetrated by an outside party. It was a painful, but contained event. Contrast this with a company that is repeatedly found to be engaged in accounting fraud across different divisions. That is not a one-time event. It's a symptom of a corrupt corporate culture, a systemic rot that will likely lead to more problems. You are looking for isolated accidents, not patterns of self-destruction. This analysis is fundamental to value investing. Step 3. Is the balance sheet strong enough to weather the storm? This is a crucial, non-negotiable step. A company with a fortress balance sheet, with lots of cash and little debt, can survive almost any temporary business problem. A company drowning in debt has no room for error. When the crisis hits, its creditors may get nervous, and it could be forced into a death spiral of forced asset sales or even bankruptcy, regardless of the quality of its underlying business. Before you buy, you must play the role of a hyper-conservative banker and analyze the company's debt levels, its cash flow, and its ability to meet its obligations. A strong balance sheet is the bridge that allows a great company to get from a temporary problem to a prosperous future. Step 4. Does the management team have a track record of integrity and operational competence? In a crisis, management is tested like never before. You want to be invested alongside leaders who are honest, transparent, and skilled operators. Did they immediately take responsibility for the problem? Are they communicating a clear and credible plan to fix it? Or are they making excuses, blaming others, and hiding information? A crisis reveals character. You only want to invest your capital with A-plus management teams because they are the ones who can navigate a crisis and turn it into a source of long-term strength. If a company passes all 4 of these checks, its moat is intact, the problem is temporary, its balance sheet is a fortress, and its management is top-notch, then the market's panic is your opportunity. The stock price drop is a gift, a chance to buy into a wonderful business at an unfairly low price. The antithesis to this disciplined approach is the path of the 99%, the amateur investor who loves catching a falling knife. This individual operates on a dangerously simplistic heuristic. The stock has fallen a lot, so it must be cheap. They see a stock that was $100 a year ago now trading at $20 and think they've found the bargain of a century. What they fail to do is distinguish between a great company facing a temporary problem and a terrible company entering its terminal decline. The amateur knife catcher does not use the moat integrity checklist. They don't analyze the competitive advantage. They buy a company like Blockbuster Video after it has fallen 50%, without realizing that its entire business model, renting physical DVDs from brick-and-mortar stores, has been structurally destroyed by a new technology called streaming. They see a cheap price, but they fail to see that the intrinsic value of the business is falling even faster. The moat has been completely flooded and breached. They don't distinguish between one-time events and systemic rot. They might buy into a bank that's had a series of scandals, thinking, this time is different. failing to recognize the pattern of a rotten culture that is destroying value from the inside out. They are drawn to the allure of a comeback story, but they can't tell the difference between a temporary illness and a terminal disease. Most critically, they ignore the balance sheet. They will buy a highly indebted airline or retailer after a big price drop, not realizing that the company is burning through cash and is months away from violating its debt covenants and potentially filing for bankruptcy. They are so seduced by the potential upside of the stock returning to its old highs that they completely ignore the very real downside of the stock going to zero. The portfolio of a knife catcher is a museum of failed businesses. It's filled with former high flyers that they bought on the way down, convinced they were getting a bargain. They confuse price with value. They think that just because a stock is down 80%, it can't go down any further. They forget that a stock that is down 80% is one that was previously down 60% and then fell by half again. This approach is not investing. It is speculation of the most dangerous kind. It is a strategy built on hope and ignorance rather than on disciplined business analysis. It is the surest way to turn market volatility from a source of opportunity into a source of catastrophic and permanent capital loss. The direct financial connection of mastering the unfair punishment principle is that it becomes the primary engine for generating alpha, or returns above the market average, in your portfolio. It is the mechanism by which you systematically acquire assets for far less than their true long-term worth, creating an enormous potential for outsized capital gains. When you buy a great company during a period of maximum pessimism, the financial dynamics are incredibly powerful. Let's quantify it. Imagine a wonderful business that you've calculated has an intrinsic value of $100 per share and is growing that value at 10% per year. In a normal market, the stock might trade around $100. If you buy it then, your expected return is roughly 10% per year. But now, imagine a crisis hits. A temporary, solvable problem. The market panics, and the stock price drops to $50. You run your moat integrity checklist, confirm the business is sound, and you buy. Now your potential return comes from two sources. First, you still have the 10% annual growth in the underlying intrinsic value of the business. But second, you have the massive potential return from the price simply reverting to its fair value. When the panic subsides and the market realizes the business is fine, the price could double from $50 back to $100. This re-rating of the stock by the market is pure alpha. It's a return you get on top of the business's natural growth, and it's only available to those who have the courage and analytical rigor to buy during the panic. This principle directly impacts your balance sheet by creating what Buffett calls look-through earnings. When you buy a stock at 50 cents on the dollar, you are essentially buying the company's future earnings stream at a 50% discount. If the company earns $5 per share and you paid $100 for the stock, your earnings yield is 5%. But if you bought it at the panic price of $50, your effective earnings yield on your purchase price is 10%. You have doubled your claim on the company's future profits simply by choosing your entry point wisely. This is the heart of value investing. It is not about timing the market's wiggles. It is about pricing businesses. The unfair punishment principle allows you to take advantage of the market's emotional pricing to acquire high-quality earning power at deeply discounted rates. This is the single most reliable method for building a portfolio that will dramatically outperform the market indices over the long term and set you on the path to true wealth management and financial freedom. The act of buying a great company at a great price is only half the battle. There is a second, equally important and often more difficult challenge: having the discipline to do nothing. The power of inaction. The fortitude to hold your wonderful businesses through the inevitable storms of bad news and negative quarterly reports is one of the most underrated skills in all of finance. It is the quiet engine of compounding. To understand this principle, there is no better case study than Warren Buffett's longest and most famous investment, Coca-Cola. In the aftermath of the Black Monday stock market crash of 1987, the market was still jittery and terrified. valuations were cheap. It was during this period, in 1988, that Buffett began to accumulate a massive position in Coca-Cola. He invested over $1 billion, which at the time represented a huge portion of Berkshire Hathaway's portfolio. He saw a simple and wonderful business. A universally beloved product, a global distribution network that was nearly impossible to replicate, and a brand that was seared into the consciousness of billions of people. It was a business with a wide and durable moat, but the crucial part of this story is not the initial purchase, it's what happened next. For the next 30-plus years, Buffett held. He held through the recession of the early 1990s. He held through the Asian financial crisis in 1997. He held through the dot-com bubble, when Wall Street was laughing at old economy stocks like Coke, and he held through the subsequent crash, when those same pundits were ruined. He held through the 9/11 attacks and the market turmoil that followed. He held through the great financial crisis of 2008, when the entire global financial system seemed on the brink of collapse. And just as importantly, he held through dozens and dozens of quarterly earnings reports. Do you think in over 120 quarterly reports since 1988, Coca-Cola never once disappointed Wall Street's expectations? Do you think there were never quarters where volume growth in a key market was sluggish, or where currency fluctuations hurt profits? Of course there were. There were countless moments when Mr. Market panicked about Coke, when the headlines were negative, when the so-called experts called for him to trim his position, to rebalance, to take some profits off the table. Buffett did nothing. He ignored the noise. Why? Because he knew the short-term news was irrelevant. His investment thesis was not based on the next quarter's sales in Germany. It was based on the simple fact that over the next 10, 20, and 30 years, more and more people around the world would drink more and more Coke products. The long-term trajectory of the business was intact. The moat was not shrinking, it was growing. By simply having the discipline to hold on, to let the business execute its plan, and allow the miracle of compounding to work its magic, his initial $1.3 billion investment has grown to be worth over $25 billion today, not even counting the tens of billions in dividends Berkshire has received over the decades. This is the power of inaction. It is the understanding that once you have bought a truly wonderful business, the hardest and most profitable work is often just sitting patiently and letting the business do the work for you. The immense difficulty of doing nothing stems from two powerful psychological forces that are deeply embedded in our nature: Nye's action bias, asterisk, and our old friend, Nye's loss aversion. Action bias is our innate tendency to feel that we must do something in the face of uncertainty or ambiguity. When a stock we own drops 20% on a bad earnings report, sitting still feels passive, irresponsible even. Our brain screams at us to act. Sell it, buy more, do something. The idea that the most intelligent course of action could be to simply do nothing is deeply counterintuitive. We equate activity with progress. In the world of long-term investing, however, activity is often the enemy of progress. It leads to portfolio churn, higher costs, and the cardinal sin of interrupting compounding. Holding a stock feels like you're not in control. Selling it, even at a loss, provides an illusion of control. At least I did something, the investor tells themselves. I cut my losses. Action bias is what drives the portfolio churner, the person who is constantly tinkering, convinced they are improving their situation when they are usually just making their broker rich. The second force, loss aversion, makes holding through volatility feel like torture. As we've discussed, the pain of a loss is twice as potent as the pleasure of a gain. When you're holding a stock that's down 20%, that psychological pain is intense. The easiest way to make the pain stop is to sell the stock and remove the source of the pain from your screen. This is a purely emotional decision, a flight response to a perceived threat. It has nothing to do with a rational analysis of the business's long-term prospects. Warren Buffett's ability to hold Coca-Cola through thick and thin is a testament to his mastery over these two biases. He has cultivated a temperament that is immune to the siren song of action. He understands that his job is not to react to every market wiggle, but to make a few great decisions over a lifetime and then let them ride. He fights loss aversion by focusing not on the stock price but on the value of the underlying business. If the business is still sound, a drop in the stock price is just Mr. Market having a tantrum. It is not a true loss of value. To succeed as a long-term investor, you must wage a conscious and constant war against your own instincts. You must recognize your innate desire to act and your visceral fear of loss for what they are, primitive emotional responses that have no place in a rational investment strategy. You must learn to find strength and wisdom in patience, and to equate progress not with activity, but with the quiet, relentless march of time and compounding. To win this war against your own impulses, you need a practical mental model that you can deploy in moments of high stress. When you are tempted to sell a great company because of a bad quarter or a market panic, you must apply the rocking chair test. It's a simple visualization exercise designed to force a long-term perspective and short-circuit an emotional, short-term decision. Here is the process. First, when the urge to sell strikes, stop. Do not log into your brokerage account. Step away from the computer. Find a quiet place and visualize yourself 10 years in the future. You are older, hopefully wiser, sitting comfortably in a rocking chair on your porch. From that future vantage point, look back on today. Ask your future self this one critical question. In 10 years, am I more likely to regret selling this world-class business because of this specific, short-term problem, or am I more likely to regret holding on through some temporary volatility? This simple act of time travel mentally transports you out of the immediate crisis and forces you to evaluate the decision from the perspective that truly matters, the long term. The noise of today's headlines fades, and the long-term strength of the business comes into sharper focus. To supplement this, you should perform what is known as a, quote, selling pre-mortem. Before you are allowed to hit the sell button, you must take out a piece of paper and answer 4 questions in writing. 1. What is the precise fundamental business reason I am selling this stock? The stock went down is not an acceptable answer. It must be about the business itself. For example, a new competitor has emerged with a superior product that I believe will permanently impair this company's earning power. 2. Is this reason a permanent impairment of the business, or is it a temporary solvable issue? Be honest. Is this a salad oil scandal, or is this a blockbuster video versus Netflix moment? 3. If I sell today and receive this cash, where will I reinvest it that I am confident will produce a better return over the next decade than the business I am about to sell? This forces you to consider opportunity cost. It's easy to sell. It's much harder to find an equally great business to replace it. 4. Am I making this decision based on a calm, rational analysis of the long-term facts, or am I reacting emotionally to a price drop in negative headlines? This final question forces a moment of brutal self-awareness. By forcing yourself through the discipline of the rocking chair test and the selling pre-mortem, you create a powerful firewall against panicked, emotional decisions. You are replacing impulsive reaction with a structured, rational process. This is the key to developing the temperament of a true long-term investor and allowing you to hold on to your winners, achieving the massive portfolio growth that comes from uninterrupted compounding. The antithesis of the patient holder is the portfolio churner. This individual lives in a state of constant financial motion, believing that activity is the key to success. They are the personification of action bias. Their approach to wealth management is a frantic and ultimately self-defeating exercise in overmanagement. The portfolio churner is perpetually dissatisfied. They can't stand to just sit and let their investments grow. They feel a constant need to optimize, to rebalance, to harvest gains. They will sell one of their best-performing stocks, a true wonderful business, for no other reason than it's had a good run. They sell their winners to lock in a small profit, robbing themselves of the massive, decade-long gains that create true wealth. This is like planting an oak tree and then pulling it up after a year to lock in its growth. At the same time, they are quick to sell their losers. The moment a stock goes against them, they sell to cut their losses. While this can sometimes be a prudent strategy for a truly bad business, the churner does it indiscriminately. They sell a great company that is down 15% on a temporary issue with the same haste as they sell a genuinely broken business. The result is that they never allow any of their ideas, good or bad, to play out over the long term. Their portfolio is a revolving door. They are constantly chasing the next hot narrative. 1 month, it's clean energy stocks. They sell their boring consumer staples to pile in. 6 months later, it's artificial intelligence. They sell the now declining clean energy stocks at a loss and chase the AI trend. They are always reacting to the last big thing, which means they are almost always late to the party, buying high and selling low as they jump from trend to trend. The financial consequences of this approach are devastating. First, their transaction costs are enormous. Every buy and sell order chips away at their principal. Second, their tax bill is a nightmare. By constantly selling, they are triggering short-term capital gains taxes at a much higher rate, year after year. They are in a perpetual battle against fees and taxes, a battle they are guaranteed to lose. But the greatest cost is the opportunity cost. By constantly churning, they deny themselves the single most powerful force in the universe for wealth creation, the magic of compound interest. $1 that is allowed to compound at 10% for 30 years without being touched will grow to over $17. $1 that is churned, taxed, and feed to death might only grow to $4 or $5. The portfolio churner mistakes motion for progress, and in doing so, they trade a future of financial freedom for a present of frantic, costly, and ultimately futile activity. The direct financial connection between the discipline of inaction and building long-term wealth can be summarized in 2 words: compounding and taxes. These are the twin titans of finance, and the power of inaction harnesses both to their full, magnificent effect. Let's first talk about compounding. Albert Einstein supposedly called it the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. When you own a share in a great business, that business is retaining some of its earnings each year and reinvesting them to grow. That growth then generates more earnings, which are then reinvested, creating a snowball effect. By holding your shares, you are a passenger on this compounding vehicle. Every time you sell, you get off the vehicle, pay a toll in the form of taxes, and then have to find a new vehicle to board. Staying put, doing nothing, allows the snowball to roll and gather mass without interruption. The difference this makes over a long period is not intuitive, it's exponential. Now let's connect this to the tyranny of taxes on capital gains. When you sell an appreciated asset, you owe the government a portion of your profit. This is a direct, immediate, and irreversible reduction of your investment capital. It is capital that can no longer compound for you. Consider this simple, stark example. Investor A buys $10,000 of a stock that grows at 15% per year. He holds it for 30 years without selling. At the end of 30 years, his initial $10,000 has grown to over $662,000. He has paid 0 taxes along the way. Investor B also starts with $10,000 and achieves the same 15% annual growth. But Investor B is a churner. He sells his position at the end of every year to lock in profits and then immediately buys it back. Each year, he pays a 15% long-term capital gains tax on his profits. After 30 years of this active strategy, how much does he have? Not $662,000. He has only about $280,000. He has lost almost $400,000, more than half of his potential wealth, to the unnecessary friction of taxes. His constant activity, his desire to do something, cost him a fortune. The financial connection is therefore crystal clear. The power of inaction keeps you on the compounding train and shields you from the wealth-destroying toll of capital gains taxes. It is the most tax-efficient and powerful strategy for portfolio growth ever devised. It may not feel as exciting as constantly trading, but the numbers don't lie. Patience is not just a virtue in investing, it is a financial superpower. To permanently insulate yourself from the short-term madness of the quarterly earnings game, you must undergo one final profound mental shift. You must stop thinking of yourself as a stock market investor and start thinking of yourself as a business owner. This is the ultimate shield against market myopia. It is the core philosophy that animates every decision Warren Buffett and Charlie Munger make. The perfect illustration of this mindset in action was their acquisition of See's Candies in 1972. This transaction was a pivotal moment for Berkshire Hathaway. Before See's, Buffett was largely a student of Ben Graham, buying statistically cheap cigar butt companies. See's was different. It wasn't statistically cheap. They paid $25 million for a company earning about $2 million after tax, a price that was about 3 times its book value. To a classic Graham disciple, it looked expensive. But Buffett and Munger weren't just looking at the numbers on the balance sheet. They were analyzing the business as if they were going to own it forever. They saw a phenomenal brand, particularly in California, that commanded intense customer loyalty. They saw a product that people bought for emotional reasons, for holidays and gifts, which made it less sensitive to price. This gave the business incredible pricing power. They could raise the price of a box of chocolates by 10% each year, and customers would barely notice and keep on buying. This pricing power, combined with the fact that the business required very little new capital to grow, meant that See's was a cash-generating machine. When they bought See's Candies, they were not buying a ticker symbol. They were buying the whole company. They thought about it as private entrepreneurs. Would they, as owners, ever consider selling their wonderful candy company because a cold spring led to slightly lower than expected Easter sales one year? The question is absurd. As owners, they were focused on nurturing the brand, expanding strategically, and ensuring the quality of the product for the next 30 years. The quarterly fluctuations were completely irrelevant to their calculation of the business's long-term value. This purchase fundamentally changed Buffett. It taught him that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The business owner's mindset forces you to focus on the qualitative aspects of a business, its brand, its competitive position, its management, things that don't always show up in a quarterly earnings report, but are the true drivers of long-term value creation. When you truly adopt this mindset, the daily stock price quotes from Mr. Market become a mere distraction. You wouldn't sell your family's successful local hardware store because someone walked by one day and shouted a low-ball offer at you. Why would you treat your fractional ownership in Coca-Cola or Apple any differently? The shift from stock picker to business owner is powered by a fundamental change in your psychological framework. The key principle at play is the asterisk ownership effect, asterisk, a well-documented cognitive bias where we place a higher value on things that we own. When you think of yourself as merely renting a stock, as a temporary holder of a ticker symbol, your commitment is shallow. It's easy to sell at the first sign of trouble. But when you reframe it in your mind that you are a part owner of the enterprise, your psychological connection deepens. You feel a sense of stewardship. You're more likely to do the deep research required to truly understand the business, just as you would before buying a house or a local company. This deeper connection creates the emotional fortitude needed to hold on through tough times. This is directly tied to overcoming another bias known as nominis stoppen. The typical stock market participant creates separate misstoppen. In one account, there is the stock, a little green or red number on a screen that goes up and down. In a completely different mental account, there is the business, a vague concept of a company with factories and employees somewhere out there. The business owner mindset collapses these two accounts into one. The stock price and the underlying business are inextricably linked. The stock is simply a liquid claim on the long-term cash flows of the real-world business. When you see the stock price of your company drop 15%, you don't just see a financial loss. You see the market offering you a chance to increase your ownership stake in a wonderful business at a more attractive price. The emotional reaction flips from fear to greed. You start to think like a private equity professional or a strategic acquirer. When a competitor's stock gets hammered, they don't see it as a bad omen. They see it as a potential takeover target. They are thinking about the value of the business, not the squiggles of the stock chart. Adopting this mindset is the ultimate goal for any serious participant in the capital markets. It aligns your thinking with the world's most successful capital allocators. It's not just a technique for stock picking. It's a philosophy for deploying capital that is equally relevant for entrepreneurs investing their own profits as it is for individuals managing their retirement portfolio. It is the final and most powerful defense against the emotional whirlwind of the market. So how do you operationalize this? How do you force yourself to think like a business owner instead of a stock renter? The mental model is the private buyer test, and it is the ultimate filter for any investment decision. Before you buy a single share of any publicly traded company, you must subject it to this rigorous two-part test. Part 1 of the test is the core question: if I had enough money to buy this entire company, would I do it? Would I take this business private, delist it from the stock market, and be happy to own it as a private family enterprise? This question immediately changes the entire frame of reference. It forces you to look past any short-term market hype or sentiment. It demands a deep analysis of the business itself, completely divorced from its stock price. You have to evaluate its products, its customer relationships, its management team, its culture, and its long-term competitive landscape. You have to think about its cash flows and what you, as the sole owner, would do with them. If you cannot confidently answer yes to this question, you have no business buying even a single share. If you wouldn't want to own the whole farm, why would you want to own one of the cows? Part 2 of the test is the follow-up question. If I bought this business today and the stock market were to close for the next 10 years, would I be comfortable and confident with my ownership? This is Buffett's famous closed market test. It is the ultimate antidote to short-termism. It makes the daily, weekly, and even quarterly fluctuations of the stock price completely irrelevant. The only thing that matters is the performance of the business itself over a long and meaningful period. Will its earnings grow? Will its moat widen? Will its management allocate capital intelligently? This test forces you to invest only in businesses whose fundamentals are so strong and predictable that you don't need the constant validation of a rising stock price to feel secure in your ownership. It filters out speculative ventures, faddish companies, and businesses you don't truly understand. Applying the private buyer test is hard work. It requires you to read annual reports, not just news headlines. It requires you to think like a business analyst, not a market timer. But it is the single most effective process for building a portfolio of truly outstanding companies, the kind of companies you can own for a lifetime. It is the final step in your transformation from a market participant tossed about by the waves of fear and greed to a disciplined capital allocator who uses those waves to their own advantage. The path of the 99% stands in stark contrast to the business owner mindset. The person on this path is a ticker symbol collector. Their relationship with their investments is superficial, transactional, and ultimately empty. To them, a company is not a living, breathing enterprise made up of people, products, and processes. It is simply a 3- or 4-letter symbol on a screen, attached to a price that changes every second. Their research process reflects this superficiality. They don't read the company's 10K, the detailed annual report that explains the business in depth. That's too much work. Instead, they look at price charts, trying to divine the future from past patterns. They read analyst reports, outsourcing their thinking to someone else who is likely just as focused on the short term as they are. They scroll through social media for hot tips and rumors. They could own a stock for 6 months and be unable to tell you what the company's main products are, who its CEO is, or what its primary competitive advantage is. They are completely detached from the underlying reality of the business they supposedly own. Their portfolio is not a curated collection of businesses, it's a random assortment of symbols. They might own AAPL, TSLA, and NVDA, but they have no deep understanding of Apple's ecosystem, Tesla's manufacturing challenges, or NVIDIA's position in the AI arms race. They are collecting lottery tickets, not ownership stakes. Because their connection is so shallow, their conviction is brittle. The moment a stock they own reports bad news or the price drops, their thesis evaporates, because it was never based on a deep understanding of the business in the first place. They are renting stocks, not owning them, and like a renter, they are ready to move out at the first sign of trouble. This is the mindset that makes one a perpetual victim of Mr. Market. When you see stocks as mere ticker symbols, you are emotionally and intellectually defenseless against the market's manic depressive mood swings. The price becomes the only piece of information you have, and you are forced to react to its every move. The ticker symbol collector is destined to a life of buying high on hype and selling low on fear, forever wondering why they can't seem to build any real, lasting wealth in the market. The final, direct financial connection is this. Adopting the business owner's mindset leads directly to superior time times capital allocation which is the ultimate determinant of long-term investment success. When you force yourself to think like a private buyer who will own a business for a decade or more, your standards for what constitutes an acceptable investment go up dramatically. You become incredibly selective. You no longer feel the need to have an opinion on hundreds of different stocks or to own a little bit of everything. You realize that true wealth is not built by spreading your capital thinly across 50 mediocre ideas. It is built by concentrating your capital in a small number of truly outstanding businesses that you understand deeply. This is the path of concentrated excellence, not diversified mediocrity. Look at the balance sheet of Berkshire Hathaway. It is not a broadly diversified index fund. It is a highly concentrated collection of businesses and stocks, Apple, Coca-Cola, American Express, BNSF Railway, that Buffett and Munger understand intimately and believe possess durable, long-term competitive advantages. This is the end result of the private buyer test. When you think like an owner, you want to put as much capital as you prudently can into your very best ideas. The financial impact of this is a portfolio that may be more volatile in the short term, but has a much higher probability of generating extraordinary returns over the long term. A diversified portfolio is protected from the risk of any one company blowing up, but it is also guaranteed to produce average, market-like returns. A concentrated portfolio of wonderful businesses, bought at fair prices, gives you a real chance at beating the market and achieving the kind of portfolio growth that leads to true financial freedom. The business owner's mindset, therefore, is not just a psychological trick, it is a strategic imperative. It is the governing philosophy that leads to the kind of patient, concentrated, long-term capital allocation that has been proven time and again to be the most effective path to building generational wealth. It is the final piece of the puzzle, the master principle that holds all the others together and transforms you from a gambler into a true capital allocator. You have just spent this time acquiring a powerful mental arsenal. You have learned to see the market not as a wise sage, but as an emotional, manic-depressive partner named Mr. Market. You have learned to dismantle the fallacy of precision that drives Wall Street's obsession with quarterly earnings. You now possess the frameworks to identify when a great business is being unfairly punished for a temporary problem, and you have internalized the profound wealth-building power of disciplined inaction. This is not just theory, this is the operating system used by the greatest investor of all time. You have just installed a crucial piece of that system into your own thinking. You have learned how to go on offense, how to use market panic and volatility as your greatest source of opportunity, turning fear into fuel for your financial future. You have fundamentally separated yourself from the reactive emotional crowd. But this is only one side of the coin. The system of thought that creates enduring wealth is not just about a powerful offense. It is a complete architecture, and it rests on an equally powerful and arguably more important foundation: a relentless, obsessive focus on defense. Learning how to buy great companies when they are on sale is how you get rich. But learning how to avoid the catastrophic mistakes that lead to a permanent loss of capital is how you stay rich. This principle of exploiting short-termism is a pillar, a critical one, but it is part of a larger, interconnected network of mental models. You have mastered a key part of the offensive playbook. But what about the defensive playbook? What about the specific rules for avoiding the value traps, the seemingly cheap stocks that are actually on their way to zero? What about the mental models for assessing business quality before you even get to the point of waiting for a crisis? The journey to becoming a truly sophisticated capital allocator, an intelligent investor in the truest sense, requires mastering both. The video that is now on your screen is the next piece of that map. It is the other side of the coin. It represents the crucial link between the offensive strategy you've just learned and the defensive discipline that protects and preserves the wealth you will build with it. It is the missing link that connects the art of buying right with the even more important art of not losing. The choice to continue is not about watching another video. It is a declaration of your intent. Amateurs and gamblers focus only on how to make money. Professionals, true masters of the craft, become obsessed with the art of risk management and the avoidance of irreversible error. The choice to continue your ascent, to complete your mental arsenal and become a true capital allocator, begins with that next step. The journey awaits.